Behind the gold and silver $10 trillion crash, what they don't want you to know, a multi-trillion-dollar crash in a single day. The media called it profit-taking. The so-called experts called it a flash crash. But I'm going to show you the evidence that suggests it was neither. It was a controlled demolition of the precious metals market. And tonight, I'm not just going to give you a theory, I'm going to show you the script, the powerful players who wrote it, and the one clue they left behind that unravels it all. What happened wasn't an accident, it was an ambush, and you were the target. Let's break down the timeline, because the timing is everything. It all started on a Tuesday, the markets were euphoric. Gold was screaming past $5,500 an ounce, peaking at nearly $5,600. Silver was rocketing, trading above $121 an ounce. The mainstream narrative was that a weak dollar was on the horizon to boost exports, and traders were piling in. Hedge funds went short the dollar, and retail investors chased the rally. The trap was set. By Thursday, the market was a fever pitch of greed. Influencers were screaming about $500 silver, and everyone who was in was dreaming of life-changing wealth. They pushed the market to its absolute peak, and then, overnight, while you were sleeping, the execution order was signed. Friday, news hits the wire. The Trump administration nominates Kevin Warsh to be the next Fed chair, a known hard money hawk, a vocal advocate for a strong dollar. It was the exact polar opposite signal from just days prior. What happened next was a massacre. Anyone who had shorted the dollar was trapped. They had to cover, and to do that, they had to sell assets. They dumped gold. They dumped silver. But this wasn't a normal dip. This was a collapse. In a single day, silver cratered, falling as much as 36%. Gold was hammered, losing over $600 an ounce at one point, a drop of over 11%. In a matter of hours, stop-loss orders triggered a cascade of selling. Margin calls vaporized accounts. The ProShares Ultra Silver Fund, AGQ, which is leveraged, fell a stunning 60% in one day. All told, the financial carnage was estimated at up to $7 trillion in value, wiped from the interconnected markets. The greatest precious metals rally in recent history was systematically and surgically demolished in less than 24 hours. So what did the talking heads on TV tell you? They called it healthy profit-taking. They said the market was overbought. They used their favorite phrase for when they have no real answer, a flash crash. But we have to ask the questions they refuse to. Does healthy profit-taking cause silver to have its worst day in history? Does a flash crash happen to be perfectly timed with a major policy pivot announced on a Friday? Does a correction just happen to benefit the very institutions that were holding massive short positions against the metals? Of course not. The official story is a smokescreen, designed to make you feel like you were just on the wrong side of a random market move. They want you to feel powerless. They want you to believe it was your fault, but it wasn't. You didn't misread the market, you just didn't have a copy of their script. To understand what really happened, you have to ask who benefits. Who had the motive, the means, and the opportunity to orchestrate a takedown of this magnitude? First, let's talk about the major commercial banks. It is a documented fact that a handful of large banks consistently hold massive, concentrated short positions in the gold and silver markets. When prices skyrocket, these banks are on the hook for billions in losses. A sudden, violent crash is their get-out-of-jail-free card. Then you have the exchanges themselves, like the CME Group. They are the market's casino operator, and they have a powerful weapon they can deploy at any time: margin requirements. By jacking up the amount of collateral traders must post to hold a position, they can create a forced liquidation cascade on demand. It's not about managing risk, it's about controlling the price. And finally, you have the central banks. As you will see, while they publicly champion their own fiat currencies, Their actions suggest they are secretly preparing for a world where those currencies fail. They have every incentive to crush the paper price of gold and silver so they can accumulate the real, physical metal at a discount. These players aren't competitors. They are partners in a system designed to maintain control. This is the kind of information they don't want you to have. They count on you getting your news from the same sources that feed you the official narrative. If you believe in digging for the truth, do me a favor and hit that subscribe button right now. Your support helps get this message out, because what I am about to show you is the most damning part of it all: the motive. This crash wasn't random. It followed a playbook that has been used time and time again. First, you have the weaponization of policy. The whiplash between a weak dollar hint and the strong dollar Warsh nomination on Friday wasn't a coincidence. It was a classic bait and switch, designed to lure in maximum investment right before pulling the rug. Second, let's look at the history of the CME's actions. This isn't the first time margin hikes have been used as a weapon. Ask anyone who traded silver in 2011. The price ran from $8 to nearly $50. What happened? The CME hiked margin requirements 5 times in just 9 days, an 84% increase. The price collapsed. Go back even further to 1980 with the Hunt brothers. As silver ran to $50 an ounce, the exchange changed the rules mid-game, instituting Silver Rule 7, which allowed for liquidation only. It killed the rally and crashed the price by 80%. Once is an accident, twice is a coincidence. 3 times, it's policy. But the real crime scene, the irrefutable proof of manipulation, is the disconnect between the paper price and the physical metal. This is a well-known manipulation tactic called spoofing, where traders place huge orders with no intention of executing them, just to create a false impression of supply and drive prices down. It's not a theory. J.P. Morgan paid a $920 million settlement in 2020 for doing exactly this in the precious metals markets for years. They have the playbook, and they have the fines to prove it. So why? Why go to all this trouble to orchestrate such a massive crash? The answer is simple. It's the biggest wealth transfer in modern history. While the media tells you that gold is just a rock, central banks around the world tell a different story with their actions. In 2023, central banks bought a near-record 137 tons of gold. They are quietly moving out of U.S. treasuries and into hard assets. They see the writing on the wall for the current fiat currency system. They need to accumulate as much physical gold as possible before that system resets. But they can't just go into the open market and buy it. That would send the price to the moon. So what do? You could argue they use their allies in the banking sector and the power of the paper markets to engineer a crash. They create panic. They scare you, the retail investor, into selling your holdings at a loss. And who is on the other side of that trade, scooping up your physical metal for pennies on the dollar? They crash the paper price to accumulate the physical asset. They are transferring real, tangible wealth from your hands into their vaults. So let's recap the script. You have the weak dollar bait to lure everyone in. You have the perfectly timed Warsh nomination as the trigger. You have a history of the CME using margin hikes as a weapon to force liquidation. You have the paper market spoofing as a proven mechanism to create a crash out of thin air. And you have central banks waiting in the wings to scoop up physical metal at fire sale prices. This wasn't a market crash, this was financial warfare. But now you are no longer an unwitting victim. You have the playbook. You know the script. When you see a massive disconnect between the paper price and what a physical dealer is asking, you know the game is rigged. That gap is your signal. It's the signal that the true value is not what's on the screen, but what's in your hand. The fear you feel right now is their primary weapon. Don't let them use it against you. History has shown time and again that these takedowns are the moments of greatest opportunity. After the 1980 crash and after the 2011 crash, prices eventually recovered and went on to new highs. They fought this hard because they are terrified of what gold at $10,000 and silver at $300 would expose about the failure of their entire system. Act now. Share this video with at least one person you know who is panicking so they don't make the mistake of selling at the bottom. Then go down to the comments and tell us, are you holding or are you folding? Finally, hit that like button and subscribe to show them that we see what they're doing and we are not falling for it this time.